How's it going, everybody? And this is Dennis back with another video. And before we even start, I have to say I made a mistake, guys. I made a mistake with YieldMax ETFs. And before all the bears and all the guys who are thinking that I'm going to flip my opinion and I'm selling off YieldMax ETF, and finally he's admitting that the investment was horrible. No, this is not what this video is about. I am not about to go on a rant saying that I sold my positions on YieldMax ETFs. I'm switching up and I no longer believe in these funds. Nope. That is not what I'm talking about in this video. Actually, I'm just giving or updating on information that I stated incorrectly in my previous videos. And I did post about this in my community tab on my YouTube channel a day ago from recording this video. And the date this video is going up, it's going to be 3 to 4 days. So yes, I did clear it up before posting this video. And I did notice this when I was going over my videos, when I was going to create the video for this week. In these two videos where I messed up on my information and I gave false information was on how to invest in YieldMax ETFs, which came out last week, and then TSLY ETF reverse split, which came out roughly a month ago. So the mix-up that what happened was I gave the wrong information. The wrong information was based on the theory that I gave that if you were to buy YieldMax ETFs and hold it for 2 years, you would be break even. Where this information is false or incorrect when it comes to giving it to you guys and giving out this information on the internet is because I forgot to add the biggest thing to this whole strategy and this whole opinion of that in 2 years you're break even is that your YieldMax ETF original investment or the YieldMax ETF original average has to stay the same. So say you bought at $20, on average YieldMax ETF has to stay around $20 value through those 2 years. And that's the information I forgot to state. The reason being, of course, we have NAV erosion and we also have dividend erosion. So say you purchased at $20 and of course you're getting 50 to 60% returns. At $20, those 50% will be based off the $20 the stock is worth. If the stock falls now to $15, that 50% will not be paid out on the $20 you bought at. It will be now paid out at the $15 that the stock is worth, meaning your dividend has eroded as well as your NAV, meaning you're no longer able to get a break even in 2 years. And that does not end there. Of course, I love spreadsheets and I made a spreadsheet just for this video where we're going to go ahead and take a look at 3 strategies that I talked about in both of these videos, which was 100% out, 50-50, so 50 in, 50 out, and then 100% in. So we're going to be looking at the strategy on a yearly basis as well, and seeing what the returns are with dividends, what the returns are with NAV erosion, and then NAV erosion with dividends. So, of course, once again, I apologize on the false information or incorrect information or just lack of information when it came to the strategy I was talking about, but I had to clear it up after reviewing both of the videos and going over and seeing that I made that mistake. So, now that that is past that, what is this spreadsheet? Well, of course, we're going to go over all these 3 strategies with better detail, talking about NAV erosion and dividend erosion based off historical evidence that we have seen so far with TSLY. So I'm using TSLY. I always use TSLY because TSLY is a good way to demonstrate NAV erosion, dividend erosion, because we are going in the huge down market with TSLY. We have lost roughly 51% in a year, and then in the past, since inception of the ETF, we've lost 61.52%. Right? Of course, that's without dividends. But anyways, it shows us a good demonstration of a bad time for YieldMax ETFs. So meaning we could use this for other ETFs in case they also experience bad times, such as TSLY. But all that out of the way, let's go through this spreadsheet. So the starting investment we're going to assume is $10,000. Your yearly return average is 50% based off, the lower end of TSLY. Your monthly return average is 4.60%. Of course, that's, the 50% average to the 12 months. And then the monthly NAV growth and loss is negative 4.16 because in the past year, we have lost 51.60% return or NAV. So looking at our first strategy, which is 100% out, looking at the dividends. So your first month, you can see you begin to lose and lose and lose as the months go by. We're not going to go through all the numbers. We're just going to go ahead and look at the ending numbers. So when it comes to dividend 100% out, your total dividends paid over those 12 months period. We're doing 1 year periods, by the way. So 12 months, 1 year. After 1 year of holding TSLY and experiencing NAV erosion and net dividend erosion, you are left with $38.2816. So $3,828.16 paid out in total dividends. Your yield after a year is now down to 38.28% on total paid out from all these 12 months. So after these 12 months, your total yield paid out was 38.28%. It's no longer 50% as you thought before due to yield decay and also yield and dividend decay being together, and as well as NAV decay. Now with total NAV and dividends paid out, so we're adding the NAV and the dividends, you're left with $9,833.84. So we're not that far from our initial $10,000 investment. Assuming you did not take this cash and waste it somewhere else, or maybe you reinvested into another ETF that did a little bit better than TSLY. Of course, we're not looking at all that, but assuming you just kept this at cash and you just had the NAV erosion, you would have $9,833.84 left over. Now, with total percent return from dividends out with no NAV erosion, so that would be 38.28%. So that would be the dividends paid out divided by $10,000 that we put in. That would give us a yield, of course, as 38.28%, as seen over here. Total percent return from dividends out with NAV erosion. So we're taking the NAV erosion, and then we're taking the percentage loss there, and then adding the percentage gain by dividends, leaves us with negative 1.66% return. Meaning, once you calculate dividends into the NAV erosion, we are only down negative 1.66%. And of course, our total income made is $3,828, which is how much dividends we took out. So what does this show us with the first strategy? Well, of course, it shows us that if you are fully reinvesting out, or not reinvesting, you're fully taking money out and you're keeping it as a cash on your account, you will be down negative 1.66%. Negative 1.66% in a downtrending market for TSLY, which has been going down on average negative 4.16% or 51% for this year. That is a pretty, I would say, a pretty decent return, I guess. It's not really a return. You're down negative 1.66%, but being in a bear market and assuming that you're probably not going to stay in a bear market the whole time. If you are staying in a bear market the whole time, that is probably not a good investment in the first place. But of course, Tesla's experiencing hard times, and we're going off TSLY. So negative 1.66% is not that bad. And as we will see with the other strategies, it's a pretty decent strategy. Of course, you're not going to be growing your position. This position will continue to decline and decline unless TSLY pivots and continues to start growing instead of going down negative 4.16%. It'll start growing by maybe up 4.16%, and then this will slowly begin to climb back up. So this is a good way to just take your money out and save as much as you can. Now, going into our second strategy is 50% in and 50% out. Now, what we did here, of course, we did the same thing we did up here. We have the NAV erosion on the left. We have the dividend in, dividend out, and then the yield decay. So with dividends coming in, so being reinvested back into the NAV, and then dividends taken out, we reinvested $2,126.73 back in, and we took out $2,126.73 out. As you can see, our dividends significantly increased from the prior strategy. So the prior strategy, we had $3,828. Now we have $4,253.47, as well as our NAV has, kept up and has not declined as much as the previous strategy. Before it was $6,005, now it's $7,531. And now looking at the percentages. So our total with NAV and dividends paid out is now left at $9,658. But if you look at this, it is still lower. The reason for being lower is because here we are calculating for total dividends paid out. So the dividends reinvested are not going into this, since dividends reinvested are going into the NAV. And as well, when we were calculating the dividends reinvested, we were calculating it being invested in the beginning of the month. So when you're being paid out your dividends, you would instantly reinvest using DRIP. Therefore, you would also receive the decline or the NAV erosion of those dividends reinvested. I know that was a lot of words right there for a second, and it might sound a little bit confusing, and I also did confuse myself for a second. But this is calculating the $2,126 right here. So the $2,126 plus your NAV. The reason being because the dividends reinvested back in are calculated back into your NAV. Since the strategy we are using here is a drip strategy, meaning you get your dividends and they're reinvested back into, similar to what the NAV is at that time. And they experience NAV erosion with them as well. So with all that gone through the complicated stuff, making my brain hurt as well, probably yours as well, our yield decay was only 42, or our total yield was 42.53% compared to the 38.20%. When we look at total percent return from dividends out, just making that clear, this is only with the dividends that came out. So we have this cash with no NAV erosion. We have a return of 21.27%. Of course, it's lower because we did not take 100% of the dividends out. We only took 50% of it out. So 21.27%. Now, total percent return from dividends out with NAV erosion is negative 3.41%. So technically, we are losing more. We're almost double on the loss when it comes to the percentage-wise from our initial 10,000 to the negative 3.41% we have now. Reason being is because we are only calculating dividends out. But where does this strategy do better? Of course, here we have bigger numbers, we have bigger returns. Wouldn't this strategy be better, right? We only have negative 1.66% down, and we have a dividend. We have dividends paid out of 3,828. But your NAV does erode. This strategy, 50 in, 50 out, works better for someone who's trying to keep their NAV up, who's trying to keep their dividends and their shares growing and staying steady. As we can see here, we did not dip under the 3% mark. Well, here we dipped under the 3% mark after the 8th month, meaning this allows you to keep your dividends higher for longer, which is good. And of course, you're averaging down, and this is assuming that you expect TSLY to go up in the near future. This would be a good strategy to average down, continue averaging down while TSLY goes down. And of course, when it goes up, these dividends will rise faster, and this NAV will rise faster than the first strategy, which is taking 100% out and not reinvesting anything back in. For this strategy, you would need the 10,000. You would need the NAV to go back up to what you bought the 10,000 for. Here, if you are averaging down, you could go up to maybe the 3rd or 4th month of whatever your average was, because you are averaging down. So that's the first strategy. That's the second strategy. Let's move on to the third strategy, which is 100% in. So once again, everything's the same. Looking at the dividends, our total dividends paid out was $4,739. Or sorry, not paid out, but total dividends paid. Just need to make that clear. Total dividends paid was $4,739.06, and those were completely reinvested. And of course, your dividends total percentage paid out was 47.39%. Your total with NAV and dividends paid out was $9,403.13. The reason being is because you had no dividends paid out. The reason you had no dividends paid out is because all dividends were put back into TSLY, meaning your NAV is your total with NAV and dividends paid out. Your total return from dividends without NAV erosion is 0 because you took out no dividends, so you technically made no income. Total percent return from dividends out with NAV erosion is negative 5.97%, since all the dividends you return back into it also experience NAV erosion, since we are using the drip method, meaning you are reinvesting on every single dividend paid out. You reinvest that same week, and assuming you're able to reinvest around the same average price. So negative 0.59% after NAV erosion of your dividends reinvested, and the NAV also experiencing erosion. And of course, total income made, 0. You did not take any dividends out, therefore your total income made is 0. Now, if we look at this, we can see 47.39% here, 42.53% here, and 38.28% here. What does this show to us? Well, this shows that if you're someone who believes in Tesla going up, right? If you're investing in TSLY and you are someone who believes that Tesla will go up in the near future or in the far future, and you want to continue to average down and continue to receive similar dividends, as 47.39% is only roughly 2.5%, 2.7% away from 50%, compared to 42.53, which is is roughly 5.5% away, 7.5% away, or 38.28%, that's almost 11.5% away, right? 12% away. So this allows you to keep most of the dividends, and continue to keep receiving the similar dividends, right? We didn't even dip under 3.9%. We were in the 1 year period, we were able to stay at the 3.9% and above, right? We were able to continue to get the same amount of yield. Of course, we did not make any income, and that income that dividend that we did make did experience erosion. But assuming that after this year period, Tesla will go up, this will set you up for your best way up, right? Since you'll be averaging down, fully down, 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 this will set you up for the best when it comes to Tesla going up. When Tesla begins to go up, this strategy will grant you the best yield. When it comes to the first strategy, this will grant you the best yield when Tesla is going down. Of course, if Tesla is going down and you don't think Tesla will go back up, this will grant you the best yield because you're receiving income, right? You're able to take this out, you're able to use it, you're able to invest it into other places, you're able to do different things with your income, right? You're taking the money out. Now, the second strategy, the middle strategy, I think is the best in the middle. I think this is the best strategy, the one in the middle. And before we get to that, before we get to the opinion, we'll just take a look real quick at the 2-year chart. Since, you know, like I said, the whole point of this video is because I made the mistake of stating that in 2 years you will be able to break even if you just took out the cash that you made from TSLY, without stating that there's an NAV erosion also, and that it would have to be an average at the same average price per share. If we did the first strategy, we took 100% out, and we did it for 2 years instead of 1 year, our total dividend will be $6,127.23. Our return over the 2 years will be 61.27%. That'll be our total return, not our average return, our total return. Our total with NAV, dividend, and paid out will be $9,734. Of course, 61.27. We would lose negative 2.66%, and our total income made would be $6,127.23. If we look at the 1 year chart, it's not that different, right? Of course, the dividends did not double. Since, you know, you would think in 2 years it would double. It did not. It was a little bit under double. But the return, the total percent return is negative 2.66 compared to negative 1.66. So the decline in the NAV actually also didn't double. So with this known, of course, you can't fully return all your money after 2 years, and that was my incorrect information on that. If NAV erosion continues to be like it is now on average, you will not be able to return all your money after 2 years. I apologize. Information was incorrect. You would need the NAV price to stay the same and NAV erosion to slow down for that to happen. But back to this. Why do I think the second strategy, 50% in, 50% out, is the best strategy? Because I think it's a hybrid strategy. By hybrid, I mean it gets the best of both worlds, right? You're at 42.50% total return. You're still above the 3% mark when it comes to monthly returns. Your dividends, you're able to take out cash, which you can invest into other ETFs, other strategies, option wheel strategies, other ETFs that are on the market. You're also having $2,126 going back into reinvestment, so you're averaging down. And overall, yes, negative 3.41% compared to negative 1.66%. And yes, it's $2,126 in income compared to $3,828. And of course, yes, it's $7,531 in NAV compared to $9,403 in NAV. But here, you're making no income, and you're betting that Tesla will go up, and you're continuing to reinvest and reinvest and reinvest and reinvest, while not necessarily growing your portfolio. Of course, you're growing your shares, but your shares don't mean anything if Tesla doesn't go up. And since Tesla doesn't go up, TSLY doesn't go up. So you would just continue to go down, 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 which is what a lot of bears and a lot of people say about YieldMax ETFs, that it will continue to go down, 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 down. But that is only with TSLY, as we've seen with other ETFs such as YieldMax and AMZ and GUI and MSFO, that they do in fact go up when the underlying goes up. But the second strategy is the best strategy in my opinion. Of course, I had that first video right here where I just gave a basic overview of it, and this is a more detailed one, right? We have NAV erosion, we have dividend erosion. It demonstrates what would happen in a year, and it also uses TSLY, which is one of the worst performing YieldMax ETFs they have, and which is a good way to show an example of, right? This is the best way to show an examples, and using history from a YieldMax ETFs that had the worst stretch of the worst experience. TSLY had the worst experience, so in times of doubt, use the worst one to to think about the strategy for the best times, right? Everything is good. It's better to start at the worst times, so then at the good times, you know what you're doing. But besides that, that is my overview. And once again, I just want to apologize about the previous two videos. Of course, TSLY ETF reverse split and how to invest in YieldMax ETFs. I was incorrect with my statement that you would be able to break even in 2 years. You would only be able to break even in 2 years if the average return or the average price, so the average price per share, so say we bought right now at $15.73, on average, it would have to stay around $15.73 for you to break even in 2 years. And of course, also the dividends would have to stay roughly the same as well, meaning volatility and premiums paid out by Tesla. So once again, apologies for the misinformation and the information I was missing in the videos. And this is hopefully a clear up. Hopefully this is a more detailed view on the possibilities of these strategies. So 100% out, 50% in, 50% out, and 100% in. It depends on what you believe would happen with TSLY, what you believe will happen with these YieldMax ETFs, right? This is not financial advice. This is not, I don't know what your portfolio is like. I don't know what your strategies are like or what your emotional limits are. But if you want to see your dividends or your NAV stay pretty high, so $9,403, you're close to your 10,000 mark. If you want to see, if you're not really good when it comes to seeing red, I would say do the third strategy. And if you believe in Tesla in the long run, I'll say do the third strategy. If you just want to make income and get out of TSLY in the long run, I'll take the first strategy. If you're okay with seeing red and you believe in Tesla too, like you could do the first strategy if you believe in Tesla. You can make your income as well as, get the NAV back if Tesla goes up. Of course, you're limited because cover call strategy. But if Tesla goes up in the future, your NAV will go back up, and your dividend will also go back up. Your average dividend will also go back up, and you'll be having your income as well. So this also could be a bullish strategy for Tesla, but a more income-based strategy. This could be more of a keeping your NAV strategy, and no income. And this one, like I said, is a hybrid strategy. You're getting income, you're averaging down for your NAV. Of course, it's not as good as 100% in, but it's 50. It's better than nothing. And I think this is a good one in the middle. You get your income, you get your NAV, you still get your NAV erosion, but at least you're averaging down. So in case Tesla does go up, you're able to go up faster than, let's say, going 100% out. Of course, you're not going as fast as 100% in, but like I said, it's a hybrid. It's right in the middle. It's the sweet spot. And that's pretty much it. Thank you everybody so much for watching. Once again, apologies for the misinformation in the previous videos. And I'll see you guys next week with the video that I was supposed to do this week. And it's going to be a nice one. I hope it's going to be a nice one. And I hope you guys stay in tune for it. So thanks so much for watching, and I'll see you guys next week.